Committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Oversight of Prudential Regulators. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And just for everyone's awareness, situational awareness, we have a vote series at roughly 10:30 this morning. We'll get to as far into this program as we possibly can. And when one Democrat and one Republican return to the committee after those votes, we will commence questioning once again. We're going to try to get as many questions with the time for these 4 important regulators for them to submit to their oversight function, obviously, but also be able to get back to work at their agencies, because there's much work to be done. I now recognize myself for 5 minutes to give an opening statement. And good morning. I appreciate our witnesses for appearing today. The last time you appeared before this committee, we were facing significant turmoil in our regional banking system. Since then, you have employed a never let a crisis go to waste mantra, attempting to use recent uncertainty to justify your sweeping rewrite of regulations for U.S. financial institutions. It doesn't go unnoticed. No one is buying that spin, by the way. The most significant proposals, including the Basel III endgame, are overwhelmingly dominated by provisions that have nothing to do with what happened in March. Rather, it appears the onslaught of your agency's regulatory proposals are intended to turn private banks and financial institutions into public utilities. This would put unelected bureaucrats in charge of balance sheets, credit flows, and evaluation of what is and is not considered risky. So let's start with the Basel III endgame proposal, which involves hundreds of billions or even trillions of dollars of resource allocation. This initiative was put forward with no convincing rationale, no credible motivation, and a shocking lack of supportive quantitative economic analysis. Even worse, the Basel III endgame would stifle economic growth here in America and globally, limiting lending and hindering the American dream of homeownership for families across the country. Additionally, banking regulators appear to have abandoned even the slightest notion of promoting American interests. Instead, you've ceded your authority over to U.S. financial regulation to opaque and unelected and unaccountable global governance bodies and NGOs, allowing European counterparts to set the agenda and put our financial system at a competitive disadvantage. One need only look at the recently proposed federal principles for climate-related risk management. These principles align closely with those being pushed by global governance bodies rather than the best interest of our financial system or even the effects of climate change here in the United States. Regardless of whether you call it guidance or regulation, these principles are significant, did not go through the appropriate process as governed by the Administrative Procedures Act. That's why I will request a GAO exam, request GAO to examine whether they constituted rule and would be subjected to the Congressional Review Act. Similarly, in a win for consumer protection, the GAO recently ruled that the SEC's misguidance SAB 121 does meet the Administrative Procedures Act's definition of a rule, making it subjected to the CRA. It seems the only area Biden financial regulators don't take their cues from foreign counterparties is digital assets, by the way. While other jurisdictions implement robust consumer protections and clear regulatory frameworks, we continue to fall behind, especially this administration. I'll finish with this. There appears to be a desire to remake the American financial system to better align with regulators' political preferences, rather than to dutifully implement the laws enacted by Congress. These supposedly independent regulators are blindly following orders from the White House and political activists, leading to gross mismanagement of their agencies and the American economy. Just this week, alleged widespread and entrenched misconduct by FDIC employees were reported by the Wall Street Journal. That was well covered in yesterday's hearing. This this misconduct is a severe departure from the agency's operations to execute its mission. We often hear in the halls of Congress that things will happen because someone has the votes to make it happen. Unelected banking regulators seem to be using a similar political calculus to push their partisan agendas, whether it's at the FDIC or at the Federal Reserve for regulatory policy. The stakes are way too high to take your eye off the ball or to play political games. You must focus on the long-term safety, soundness, and stability of our financial system for the benefit of the American people and American families and American workers, rather than focus on partisanship, misleading rhetoric, or short-term political gains. This isn't about politics. This is about doing what's right for the American economy for the long term. It's about safety and soundness in the long run. And it seems like these proposals we're seeing for bank capital are about policy preferences, not driven by economic analysis. That's concerning. And Mr. Barr, that should be concerning to you at the Federal Reserve. I think the importance of the Federal Reserve's independence for monetary policy is important. You are jeopardizing it by your regulatory actions. I yield back. Now recognize the ranking member of the committee, the gentlewoman from California, for 4 minutes for an opening statement.
Good morning, and thank you, Mr. Chairman, for holding this hearing, continuing the tradition that Democrats started in holding semi-annual hearings to provide oversight of our prudential regulators. I want to take this opportunity to applaud our nation's regulators. After the failures of Silicon Valley Bank, Signature Bank, and First Republic, which marked the second, third, and fourth largest bank failures in our history, it was our nation's regulators and President Biden's Treasury Department that protected our nation's economy. Now they are taking steps to address weaknesses in our nation's banking system, including by strengthening capital requirements, and this makes some sense because well-capitalized banks lend more. Committee Democrats are also doing our part to prevent another banking crisis. We have introduced a wave of bills to address gaps exposed by the bank failures, such as strengthening bank executive accountability. Several of these bills are advancing with broad bipartisanship in the Senate, and I urge House Republicans to take them up as well. I'm hoping we can discuss legislation today to strengthen deposit insurance to better protect small businesses and their employees. I also want to applaud our banking regulators for finalizing the Community Reinvestment Act rule, something that had not been updated in nearly 3 decades. So under my leadership, Committee Democrats led the way to protect the CRA when the Trump administration tried to gut it, including by crashing a FDIC board meeting. So I'm pleased that regulators are taking action to combat modern-day redlining. I look forward to learning more about how our regulators will implement this final rule and stand ready to craft legislation that may be necessary to bolster this effort. Finally, before I conclude, I want to say that I am very troubled by recent reports of sexual harassment and toxic workplace culture at FDIC. All of our nation's regulators should provide safe work environments that are free from discrimination, harassment, and unfairness. So I look forward to learning more today about what is being done at the FDIC and the other banking agencies to ensure that everyone feels safe and respected in their place of work, and that wrongdoers are held to account. So I thank you very much, and Mr. Chairman, I yield back.
The lady yields back. We'll now recognize the ranking member of the Subcommittee on Financial Institutions, Mr. Foster, for 1 minute.
Thank you, Mr. Chairman. As many of our witnesses said before the Senate yesterday and in their written testimony for this hearing, the American banking system is sound and resilient. The bank failures earlier this year were contained, but they demonstrated that the risk taken on by a small number of firms, if not appropriately managed, can result in contagion at financial businesses across the economy, and consequently, the Americans that depend on them for essential financial services. While the stress from these bank failures earlier this year has seemingly calmed, both traditional and emerging risk persist. Traditional financial risk, like interest rate risk, and developing risks, such as rising geopolitical tensions, cyber risk, climate change, artificial intelligence, and emerging technologies, present new risks that must be managed appropriately. Our prudential regulators have advanced proposals in recent months meant to address lessons learned from both the global financial crisis and from recent bank failures. These proposals will have an effect not only on the banking system, but on the overall U.S. economy, and it is our job to understand them. Thank you. I yield back.
Gentleman yields back. Today we welcome the testimony of the Honorable Michael S. Barr, Vice Chair of Supervision for the Federal Reserve Board of Governors. The Honorable Martin J. Grunberg, Chairman of the Board of the Federal Deposit Insurance Corporation. Mr. Michael Sue, Acting Comptroller of the Office of Comptroller of the Currency. The Honorable Todd Harper, Chairman of the National Credit Union Administration. We thank each of you for your time for being here. We'll recognize each of you for 5 minutes for oral presentation of your testimony without objection. Each of your written statements will be made as a part of the record. We'll begin with you, Vice Chair Barr. You're now recognized for 5 minutes.
Thank you, Chairman McHenry, Ranking Member Waters, and other members of the committee. Thank you for the opportunity to testify in the Federal Reserve's supervisory and regulatory activities. Our banking system is sound and resilient. The acute stress that occurred in March has receded, and banking organizations continue to report capital and liquidity ratios above minimum regulatory levels. However, some banks have recorded sizable declines in the fair value of certain assets as interest rates have increased, putting pressure on tangible capital. These banks are actively managing the resulting set of risks, but these could take some time to address. Additionally, some banks that have high reliance on uninsured deposits are using more expensive funding sources to manage their liquidity. Looking forward, preserving a sound and resilient banking system requires continued attention to address identified vulnerabilities and vigilance to changing conditions. Starting with supervision, since the bank failures earlier this year, the Federal Reserve has been moving forward with ways to improve the speed, force, and agility of supervision as appropriate. In considering improvements to supervision, we are very mindful of the differences in size, risk, and complexity of supervised institutions, and the importance of maintaining the strength and diversity of banks of all sizes that serve communities across the country. Furthermore, supervisors have been focused on addressing material risks presented by the current economic environment. This includes conducting targeted reviews at banks exhibiting higher interest rate and liquidity risk profiles, and monitoring for potential credit deterioration, particularly within the consumer and CRE lending segments. A key component of this resilience is capital. Capital allows banks to absorb losses on those assets while continuing to serve households and businesses. In the global financial crisis, the effects of woefully undercapitalized banks had a devastating impact on our economy and resulted in the worst recession since the Great Depression. It took 6 years for employment to recover. More than 10 million people fell into poverty, and 6 million families lost their homes to foreclosure. And these costs occurred even with substantial support from the government. In the years following the global financial crisis, the board adopted a set of capital reforms which greatly strengthened our banking system, and capital ratios of the largest banks have more than doubled since 2009. At the same time, the U.S. banking system has grown from $12 trillion in assets to $23 trillion today, while showing strong profitability and overall market valuation. U.S. banks have enhanced their position as leaders in global capital markets activity. Importantly, these reforms have served the U.S. economy well. Our economy has grown substantially with the continued support of robust lending from a stronger banking system. The reforms to the capital requirement framework that the banking agencies proposed earlier this year are the last stage of these post-crisis capital reforms. It has long been recognized that work remained to improve how banks measure risk, which is critically important because the riskier a bank's assets are, the more capital it needs to protect against those risks. The proposed rules would apply to banks with at least $100 billion in assets, fewer than 40 of the over 4,000 banks in our banking system. Community banks would not be affected by this proposal. The effects for each bank would vary based on its activities and risk profile. Notably, the increases would be most substantial for the largest and most complex banks, the GSIBs, and the bulk of the estimated rise is attributable to trading and other non-lending activities. The comment period is an important part of the rulemaking process. We are providing the public nearly 6 months to review the proposal so they can provide meaningful comments. We welcome all comments that provide the agencies with additional data and perspectives to help ensure the rules accurately reflect risk. I would also like to briefly highlight our long-term debt proposal. In August, the agencies proposed a rule that would expand long-term debt and resolution planning requirements to additional large banks. The proposal's goal is to increase the potential options available for resolving depository institutions and to enhance overall financial stability. Importantly, the proposed requirements would be calibrated at a lower level relative to the largest and most complex banks in recognition of the lower systemic risk profiles of applicable banks. As with the capital rules I mentioned above, I would like to emphasize that these are proposed rules, and we look forward to hearing the public comment. Thank you, and I am happy to take your questions.
We'll now recognize Mr. Grunberg.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, members of the committee, I'm pleased to appear at today's hearing on oversight of Prudential regulators. The U.S. banking industry has proven to be quite resilient, despite the period of stress earlier this year. In the second quarter, key banking industry measures of performance remained favorable. Net income remained high by historical measures, asset quality measures were stable, and the industry remained well capitalized. However, banks report lower net interest margins and higher funding pressures for a second consecutive quarter. Higher market interest rates caused market values for debt to generally fall during the second quarter, resulting in higher unrealized losses on securities. In the second quarter, uninsured deposits declined by 2.5%. That's a significant slowing from the 8% decline reported in the first quarter. By contrast, insured deposits increased by 0.8% during the second quarter, and also in the second quarter, depositors sought higher yields, often at non-bank financial institutions, particularly money market mutual funds. Many banks have increased deposit rates to compete, resulting in higher cost of funds. The banking industry continues to face significant downside risks from the effects of inflation, rising market interest rates, and geopolitical uncertainty. The economic outlook remains uncertain, despite relatively solid growth and low unemployment so far this year. These risks could cause credit quality and profitability to weaken, loan growth to slow, provision expenses to rise, and liquidity to become more constrained. Commercial real estate loan portfolios, particularly loans backed by office properties, face challenges when loans mature as demand for office space remains weak and property values continue to soften. Banks have tightened underwriting standards over the past year across a range of household and business loans, and they may continue to tighten further this year. The failure of 3 large regional banks this spring demonstrated the risk to financial stability that large regional banks can pose. The FDIC, along with the Federal Reserve and the OCC, proposed rulemakings that would enhance the resilience and improve the resolvability of large regional banks. These include a long-term debt proposal that would require a layer of loss-absorbing capacity at large banks to take losses before uninsured and insured depositors, thus decreasing the incentive for uninsured depositors to run and mitigating the need for a systemic risk exception in a future failure. In July, the banking agencies issued a notice of proposed rulemaking for Basel III. The proposal is a continuation of the federal banking agency's efforts to revise the regulatory capital framework for our largest financial institutions following the global financial crisis of 2008. Notably, it does not apply to community banks. The NPR would make important changes to address capital weaknesses identified in the 2008 financial crisis, enhance the resilience and stability of the banking system, and enable the system to better serve the U.S. economy. In addition, the FDIC is undertaking a comprehensive review of its supervision program with a focus on interest rate risk, unrealized losses on securities and loans, uninsured deposits, rapid growth, and the need, when necessary, to escalate supervisory matters and take action to compel compliance. In October, the banking agencies adopted a final rule to strengthen and modernize the Community Reinvestment Act, and in my written statement, I provide an overview of the Deposit Insurance Fund and an update on our resolution and asset sale activities. In closing, I would like to address a recent news report regarding incidents of sexual harassment and misbehavior at the FDIC. As I've indicated, I am personally disturbed and deeply troubled by the report. The FDIC is conducting a comprehensive review, including engaging an independent third party to ensure that we understand the nature of the issues and will take all appropriate actions to address them. Let me underscore that I have no higher priority than to ensure that all FDIC employees work in a safe environment where they feel valued and respected. Thank you very much, Mr. Chairman. I'd be glad to answer.
Now recognize Mr. Sue.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, and members of the committee, I'm pleased to testify today to provide an update on the activities underway at the OCC. Despite the significant market stresses earlier this year and a challenging interest rate environment, the overall condition of the federal banking system is sound. OCC-supervised banks in the aggregate have strong levels of regulatory capital and healthy levels of profitability while maintaining sufficient liquidity buffers. The OCC engages directly with the institution it supervises to ensure that they are being vigilant in managing their risks. Our recently released Bank Supervision Operating Plan for 2024 summarizes the agency's examination priorities for next year and highlights asset liability management, credit risk and allowance for credit losses, cybersecurity, operational risk, and consumer compliance risk, among others, as key areas of focus. My written statement provides an update on the agency's work advancing its key priorities of guarding against complacency, reducing inequality, adapting to digitalization, and managing climate-related financial risks at the largest banks. I'll highlight some of these efforts. Despite the relative calm in the market today, the OCC has urged the banks it supervises to stay on the balls of their feet with regards to risk management. To assist banks, the OCC has updated guidance for the industry. For example, in response to increasing risk in commercial real estate, the OCC and other regulators published the policy statement on prudent commercial real estate loan accommodations and workouts, which updates existing interagency supervisory guidance on CRE loan workouts and reminds banks to work prudently and constructively with credit-worthy borrowers during times of financial stress. Ensuring that financial services are offered responsibly and fairly takes continued efforts and vigilance by banks, regulators, and other stakeholders. On October 24th, the federal banking agencies issued an interagency final rule implementing the Community Reinvestment Act. The CRA was enacted in 1977 to prevent redlining and encourage banks and savings associations to help meet the credit needs of the communities in which they operate, especially low and moderate income individuals and neighborhoods. The final rule modernizes the CRA by recognizing banking activities that take place beyond the physical branches and ATMs, being significantly more data-driven and objective, and providing for greater transparency. It strengthens the CRA by addressing concerns related to grade inflation and CRA ratings by better incentivizing CRA lending and investments in LMI communities. The rule tailors evaluations and data collection to bank size so that community banks do not have additional burden. Banks' relationships with third parties, including financial technology companies, continue to expand. The use of third parties has significant potential benefits, but poor third-party risk management can hurt consumers, weaken banks, and contribute to an unlevel playing field. Recently, the OCC and other regulators jointly issued guidance on interagency guidance on third-party risk management, reminding banks of their responsibility to operate in a safe and sound manner and in compliance with applicable laws and regulations, regardless of whether their activities are performed in-house or outsourced. The OCC also recognizes the considerable interest by the banking industry in artificial intelligence. To date, banks have generally approached machine learning and AI cautiously across a range of use cases. The potential benefits of more widespread adoption of AI are significant, but so are the risks, which is why we expect banks to continue to manage appropriately. In the digital asset space, attention is shifting from crypto to the tokenization of real-world assets and liabilities. In contrast to crypto, tokenization is driven by solving real-world settlement problems and can be developed in a safe, sound, and fair manner. Next February, the OCC will host a public symposium on tokenization to take stock of developments, help enable strong foundations, and promote public discussion. This fall, the OCC, along with the Federal Reserve and FDIC, approved principles for climate-related financial risk management for large banks. The principles are focused exclusively on risk management and do not tell bankers what customers or businesses they may or may not bank, but clarify how large banks can maintain effective risk management and keep their balance sheets sound so they can continue to be a source of strength to their customers and communities through a range of severe weather scenarios. In closing, the OCC continues to be engaged in a range of efforts to ensure that OCC-supervised banks operate in a safe, sound, and fair manner, meet the credit needs of their communities, treat all customers fairly, and comply with laws and regulations now and into the future. Thank you. I'd be happy to answer your questions.
We'll now recognize Chairman Todd Harper.
Chairman McHenry, Ranking Member Waters, and members of the committee, thank you for the invitation to discuss the recent work of the National Credit Union Administration. My remarks here will focus on the state of the credit union system and two legislative requests. During the last year, the credit union system has largely remained stable in its performance and resilient against economic disruptions. At the end of the second quarter, the system had $2.2 trillion in assets and $1.5 trillion in loans outstanding. And the system's aggregate net worth ratio was 10.6%, well above the 7% well-capitalized leverage ratio required by statute. The Share Insurance Fund also continues to perform well, with no premiums expected at this time. And to better position the fund's liquidity in the current economic environment, the NCUA has increased overnight investments to $4 billion. Nevertheless, we should pay attention to several emerging issues and trends. Net charge-off ratios at credit unions have risen over the last year, and annualized returns on average assets have declined slightly. Increasing liquidity, interest rate, and credit default risks have also led to a drop in composite Camel's Code ratings to 3s, 4s, and 5s. Assets in Camel Code's 3 institutions, for example, increased sizably in the second quarter, especially among complex credit unions with more than $500 million in assets. Ultimately, the data from the first half of the year reveal a tale of two types of credit union members. The first type are those who have shifted their share saving deposits to share certificates to capitalize on better rates. In all, time deposits have increased approximately 70% during the last year. Unless carefully managed, this switch from low-paying to higher-yielding accounts can expose credit unions to greater interest rate and liquidity risks. And the second type of members are those with growing financial difficulties. Delinquency rates on most loan types are rising, credit card balances are elevated and higher than what we should expect in the typical second quarter, and balances on home equity lines of credit and other second liens have increased by 1/3 during the last 4 quarters. In some cases, those increases may indicate household financial stress. Consequently, credit unions must carefully manage their credit risks going forward. Early intervention at the onset of a delinquency can improve the credit union member's financial footing and prevent a charge-off. The current economic environment also underscores the importance of the NCUA's Central Liquidity Facility, or CLF for short, as a liquidity shock absorber. As of September 30th, the CLF had $19.8 billion in lending capacity. This figure contrasts sharply with 9 months earlier, when the CLF had $27.5 billion in lending capacity. This sizable contraction resulted from the expiration of temporary statutory enhancements that facilitated the agent member access of corporate credit unions. To address this expiration and growing liquidity risks, the NCUA Board has unanimously requested that Congress restore the CLF's corporate credit union and agent member provisions, which the Congressional Budget Office has scored at no cost to the taxpayer. Additionally, it remains the policy of the NCUA Board to restore the NCUA's authority to examine and supervise third-party vendors. The Government Accountability Office, the Financial Stability Oversight Council, and the NCUA's Office of Inspector General have all recommended this reform. Vendor authority would allow the NCUA to gain a better understanding of the risks present in the credit union system and close a growing regulatory blind spot. And such legislation would reduce the compliance costs, due diligence burdens, and future share insurance fund premiums for credit unions. In sum, the NCUA stands ready to address the impact of the evolving risks within the credit union system, including growing liquidity, interest rate, and credit risks. The NCUA will also continue to coordinate with other financial regulators to ensure the overall resiliency and stability of our nation's economy. That concludes my remarks. I look forward to your questions.
Thank you all for your testimony. We'll now turn to member questions. I'll recognize myself for 5 minutes. I reached out to all of your agencies via letter about the influence of global governance bodies, in particular the Basel Committee on Bank Supervision, the Bank for International Settlements, as well as the Network for Greening of the Financial System. Vice Chair Barr, are Fed officials and staff from the board and from district banks compensated when they attend these meetings abroad?
Sorry, sir, I couldn't hear the last part of your sentence. Are officials what?
Compensated.
The staff at the agencies that conduct all activities on behalf of the agencies receive their...
Let me ask this again. When you attend any of these 3 international governance bodies, meetings of them, are you compensated, and are board members of the Fed compensated?
We're compensated by the Federal Reserve for
But
conducting all of
not
our
from
activities.
these global bodies. You would not receive a payment from the Basel Committee or from the Bank for International Settlements?
No, when we participate on behalf of the Federal Reserve, we're compensated by the Federal Reserve.
Okay, so there's no additional income that would come from those meetings?
No.
Okay. Acting Comptroller Sue, how is Treasury and your office's work with the global governance bodies documented?
How is it documented? I'm not sure. We keep track, obviously, of what people are doing in terms of participation in these bodies, and all of that goes through the appropriate procedures internally, make sure it's all appropriate and in line, aligned with our mission, which is focused on safety and soundness and fairness. I'm not sure what the question.
Okay, so
getting at.
you attend these, the Basel
Yep.
Meeting.
Correct.
You make decisions there. What's the reporting mechanism for Congress to know your actions there? Are there reports held internally?
The agendas of the meetings are something that are actively discussed and shared within the agency and across agencies to the extent that we attend these things together. I think that may be the closest to what you're
Yeah, is there paperwork, and where would that paperwork be held?
we have records retention requirements, and we abide by all of those.
Okay. And is that the same for you, Mr. Barr, at the Fed?
With respect to retention of records, yes, we retain all government records.
Of these international bodies. So
Of
if we
any
had
activity that-
if we had document requests, you all would provide those to us.
We'd be happy to work with you and your staff on any document requests, as we usually do.
All right. Is there compensation for your participation in these international bodies, Mr. Sue? Okay. These are the things that we don't know. They've not been attested to previously. Vice Chair Barr, about the Federal Reserve Board's announced results of the 2023 stress tests in June of this year, you concluded there, and the report concluded, it confirms that the banking system remains strong and resilient. So what economic analysis did you conduct to support your significant change in capital requirements that you're proposing?
Thank you, Mr. Chair. The preamble to the rule and the rule itself discusses in detail the analysis that went into each provision of the rule with respect to risk calculation. The rule is designed to improve the calibration of risk for things like trading activity and operational risk, improve the calibration of our standardized approach with respect to credit risk, and the details of that are discussed in the rule.
Okay, but that is objectives, and you outlined the objectives. I'm asking for economic analysis. When we met, this is what I said I was going to ask you about.
Yes, in the rule itself, we went through in quite detail for each calibration why we thought the calibration was appropriate. And then for the rule as a whole, the rule addresses the economic costs and benefits of the approach and finds that the economic benefits of reducing risk.
Certainly they do, as all agencies do. They conduct an economic analysis and say the benefits far exceed the costs. But there is no math you provide in that report that justifies your actions. These are political decisions you're making. That's my view of it. Without any backup for economic analysis, that is what the public is to conclude. Ms. Grunberg, there's a lot of discussion about your agency. I was just wondering, since you've run the agency, been there for 20 years, have you ever been investigated for inappropriate conduct during your time at the FDIC? Pardon me?
No, Mr. Chairman.
All right, well, I appreciate your candor. I believe the workplace culture starts at the top. With that, we'll go to the ranking member, Ms. Waters.
Thank you very much, Mr. Chairman. Chairman Gruenberg, it was troubling to learn of the sexual harassment reports stretching back more than a decade at the FDIC, with many of those harmed feeling like they had nowhere they could turn to get help. It was reported that you have launched a comprehensive review and you hired an independent firm to contribute to that effort. But what other steps is your agency taking today to ensure that all employees understand that this really is a top priority to provide a safe work environment and to hold individuals that engage in these shameful acts of harassment, misogyny, and discrimination fully accountable for their misdeeds?
Thank you, Congressman, for that question. This is the top priority for the FDIC now, to get a handle on these issues and address them effectively. As I indicated, I was deeply disturbed and troubled. It's quite clear that there have been FDIC employees who have experienced horrendous treatment, and it needs to be addressed because it's completely unacceptable. You indicated we've engaged an independent third party to do an agency-wide review, both of our Washington offices and our regional and field offices. And in addition, we will be looking at all of our policies and procedures to ensure that they are as easy as possible for any employee who believes that they've experienced improper conduct to file a complaint and file it securely, and to know that they will be protected, as well as looking at our processes for holding individuals who engage in misconduct accountable based on the facts and the law.
Thank you, Chairman Gruenberg. Would you commit to providing us with a detailed written plan on the steps the FDIC plans to take to address this issue in the next 15 days, as well as a written report of the findings from your comprehensive review of the matter when that concludes?
Yes, Congressman, would be glad to do that and to be entirely transparent with you and the committee as we proceed here.
Thank you. I fear we would be naive to think these cases are isolated to the FDIC. So Vice Chairman Barr, Chairman Harper, and Acting Comptroller Sue, would you each commit to developing a written plan that you will send to us in 15 days describing how your agency will review your sexual harassment policies and procedures, as well as engage with your workers and outside experts to identify steps your agency can take to better ensure that you have a safe workspace where all workers are respected and have meaningful ways to get help when they have been harmed. Vice Chair Barr?
We'd be happy to provide the committee with our detailed policies and procedures. We have strict procedures on these matters, and we'd be happy to provide those to the committee.
In 15 days.
Yes.
Thank you. Chair Harper?
In recent years, the NCUA has worked to strengthen its anti-harassment policies, including for sexual harassment, and we will provide those policies and procedures and look at what more we can do
In 15 days.
in 15 days.
Thank you. Acting Comptroller Sue.
Yes, absolutely, yes.
And you will do what?
We will do everything that you requested in terms of the commitment to review everything that we have
In how many days?
in 15 days.
Thank you very much. With it, I yield back.
Well, it's good to know these agencies can comply quickly with oversight requests, if only universal. We'll go to the Vice Chair, Mr. Hill, for 5 minutes.
Thank you, Mr. Chairman. Gosh, that's so inspirational. I may start straight away with Chairman Grunberg. You've got bank merger and acquisition applications pending before your agency. Could you provide us a list of those pending applications?
Would be glad to, Congressman.
And also just note on it how long since their application was accepted. So just, I want to know the length of time. Thanks so much. Mr. Harper, on the same sort of topic of just information, I was looking at the statistics last year, and there have been 16 banks bought by credit unions in the last year. That's of interest to both sides of the dais up here on what that means. I mean, are these tax-paying companies that are now converted to non-tax-paying cooperatives? Do they convert their deposits to shares? I don't think there's enough information on this committee. Could you send me a memo on that?
We would be happy to.
That'd be very helpful. Thank you. Comptroller Sue, you're aware the committee's been working on stablecoin legislation under Chairman McHenry's leadership and Ranking Member Waters' leadership for a couple of years now, and your staff's been really helpful, and I want to say thank you on that. Congress gave the OCC the authority to charter non-depository trust banks that limit operations to just those of a trust company and related activities. Under existing laws, a national trust bank can issue stable coins, and the OCC clearly has that legal authority to charter such a bank. Do you agree with that?
I agree we have the authority. It has to be done in a safe, sound, and fair manner, and those are the standards for any national bank, Federal Savings Association.
Right, there's 60 or so of those non-depository trust companies under your charter authority, isn't that right?
I would have to look at the details, but that sounds about right.
Yeah, and as the primary federal regulator for those, do you think the OCC staff and your team, exam team, supervisory team, are capable of supervising if they were to issue stable coins? Do you think you're competent at doing that?
Staff is extremely capable, yes.
Very good. Well, I think you do have that obligation to make sure they operate in a safe and sound manner, but I think there's been I've heard some controversy that somehow you can't do that effectively, and I think you probably can, so I wanted to verify that with you. Let me stick with you. The SEC has a new custody rule, which has concerned, again, members on both sides of this dais. And under that rule, if bank custodians now have to hold client cash off balance sheet, isn't that a fundamental shift in practice with the material impact on bank balance sheets if that were to be implemented?
Yeah, it would be a shift, yes.
Have you considered how mandatory cash segregation as proposed by the SEC would impact bank operations?
We've looked into it, yes.
Do you agree with the SEC's approach?
We have some concerns.
You have some concerns. Vice Chair Barr, do you share those concerns with the SEC's approach to this custody rule?
I think it would be a significant change in custody practices at banks, and we have shared that with the SEC.
Yeah, I think many here on this panel have. We just don't really understand it. We know they're off chasing their concerns about digital assets, but they've swept up the whole common law and state statutory and federally statutory custody practices in it, and I personally oppose it quite significantly. I think it's, I would use a technical term, dumb, I think, the way they describe their rule. Vice Chairman Barr, in August, Mr. McHenry and Mr. Heising and I sent a letter about this novel activities rule, and you were very prompt in helping send your staff up to brief our staff on how that's working. I want to talk a little bit about the intent of that. Does the Fed plan on first responding to our letter that we sent you?
Senator, sorry, Mr. Hill, if we haven't responded to your letter, then we will certainly respond. I'm not aware of the status of the correspondence.
Okay. So tell me about this non-objection status. If it proves to disincentive member banks from participating in stablecoin activities or other fintech activities, isn't that a problem? Don't we want innovation in our banking system?
We definitely want innovation in our banking system. Innovation, I think, has been critical to having a thriving financial sector and a thriving economy. We want to do that in a way that makes sure we provide clarity and certainty to banks participating in novel activities with clear guardrails on safety and soundness and consumer protection.
I'd ask you to follow up with the letter and follow up with this idea of the justification you have for the risk to safety and soundness. There were no footnotes, there was no detail. Obviously, it was a very short letter to members, so if you could follow up in writing, I'd appreciate it. Yield back. Thank you, Mr. Chairman.
We'll now go to the ranking member of the Small Business Committee, Ms. Velasquez, for 5 minutes.
Thank you, Mr. Chairman. Vice Chair Barr, you and I spoke recently about the Basel III proposal, potential impact on small business lending. While I'm supportive of the reforms, I am always concerned about small businesses' ability to access capital. What economic analysis has the Fed conducted to ensure small business lending won't be constricted or that the cost of origination won't dramatically increase because of this proposal, particularly in a high interest rate environment?
Thank you, Congresswoman, for the question. We agree that we want a thriving small business sector. Small businesses are the lifeblood of their local communities. The rule that we have proposed would not make significant changes with respect to the cost of credit for small businesses. Under the proposal, small businesses would have, generally speaking, the same risk weight that they have under current rules, but it would provide for the ability for small businesses to have a lower risk weight if they meet specified criteria.
And have you factored in the interest rate environment today?
We are trying to develop a proposal and then finalize a rule that would be appropriate throughout the economic cycle.
And have you met with any financial institutions covered by this proposal about the potential impact on their small business lending portfolios?
We do welcome comment from all banks. We've met with banks on the proposal. We've met with other members of the public, and we welcome those comments.
And if presented with credible evidence from these institutions about any potentially negative effects when it comes to their small business lending portfolios, specifically, would the Fed be open to adjusting the proposal?
We are open to all kinds of improvements to the rule. We welcome comments on the rule. We want to make sure we get the proposal right, and we'd welcome that input.
Vice Chair Barr, as you know, 40% of all small business loans are originated by community banks. And just to be clear, so there is no disagreement, community banks are exempted from this proposal, correct?
That's correct. Community banks are exempt from this proposal. It only covers the top 37 banks in the country.
Thank you. Chair Grunberg, when you and I and your colleagues appeared before this committee in May, you stated that it was realistic to believe a notice of proposed rulemaking on Section 956 of Dodd-Frank will be released by the end of the year. Is that still your expectation?
Congressman, I don't know if we're going to be able to act by the end of this year. I will tell you that, this is a joint rulemaking involving 6 agencies. It has had intense principal-level attention of all 6 agencies. I think we are in general alignment, and I think we're going to move toward a reproposed rule It may not come till the early part of next year to get everybody.
Isn't that been the case for the last 12 years?
Yes, no, I understand. Believe me. Believe me.
As I have said it to each of you before, the statute requires a completed rulemaking within 9 months, and it has been 12 years. And just so you are all aware, I will continue asking for updates on this at every future hearing until the rule is written. It is well past time you get this done. Thank you, Mr. Chairman. I yield back.
We'll now go to the gentleman from Texas, Mr. Sessions, for 5 minutes.
Mr. Chairman, thank you very much. Mr. Chairman, there's been a lot of discussion this morning about the integrity of these organizations that sit in front of you. I'd like to put into the record a copy of a Wall Street Journal article that more specifically outlines
Without
directly
objection.
what this is, and I find it incomprehensible that someone would not really be able to understand this and put an immediate response out, but rather to hire somebody outside and ask that they look at the whole organization. It may take months and months rather than issuing a direct response to that. And Mr. Chairman, I do know that the gentlewoman, the ranking member, was most explicit to ask for that back in 15 days. I want to thank her for that because I think she, like this whole committee, is disgusted at that performance level. Not making friends and success with your employees is a difficult task. Gentlemen, I'm looking at the OCC Bulletin 2023-29, issued August 29, 2023. Long-term debt requirements for large bank holding companies, certain intermediate holding companies of foreign banking organizations, and large insured depository institutions. Notice of proposed rulemaking. And as I go through this, not for the first time, but the first time in a couple days, as I look at this, it is rather extensive. You're telling them how to run their bank. You are giving them, in some instances, even several years to get where you want to go. I have a problem with this when I believe the organizations that might be the Fed and the FDIC boards might not even agree with this. What was their feedback for you before you issued this August the 29th? Mr. Greensburg?
The feedback from the institutions?
From the FDIC board.
Oh, well, I think our board actually, I believe, voted unanimously in favor of this proposal. It had been the subject of a long deliberative process. We actually had an advance notice of proposed rulemaking, I think back in 2022, to seek comment on the whole concept before initiating a rulemaking process.
So is that back to, let's say, March, this long discussion?
It extended, no, it actually preceded that, Congressman.
It actually preceded that. And the catalyst for moving forward from these discussions, was it the March?
No, I think it perhaps reinforced the value of considering the proposal, but I think it's something that the three agencies, certainly the Fed and the FDIC, have been focused on previously. We had been concerned before the events of this spring.
Concerned because of instability.
No, about the challenges relating to the failure of a large regional bank. You know, we had been very focused in the past.
So did your regular reviews of these banks, as you had this opportunity to be on them, did your reviews also come up with that conclusion? You're in institutions every day.
Yeah.
So you started seeing something when you would come in and your examiners would be there, and that's what led you to this conclusion?
It was an issue really relating to the resolvability of these institutions and how they could be resolved in an orderly way, minimizing costs to the deposit insurance fund. And focused prior to the events of this spring on the risks related to concentrations of uninsured deposits at large regional banks and the value of having a buffer of long-term debt held at these institutions, because
So that would mean then that they would then move back on their lending ability and save more, in essence, as a buffer against what might be that risk?
no, we didn't see an impact on lending. What we did see was
But
replacing.
if you're requiring them to hold more, wouldn't that mean that there's less available for them for a growing economy?
Well, again, Congressman, this is not capital, it's a debt instrument. And in effect would be, this long-term debt would replace some of the uninsured deposits that have a higher liquidity risk. This would be longer-term debt, and that longer-term debt would take losses ahead of uninsured and insured
The
deposits.
gentleman will finish the answer for the
We think-
record.
If I may, and that reduce the run risk of the uninsured deposits, which we actually obviously saw earlier this year, and also would reduce the resolution costs.
Okay, the gentleman's time has expired. We'll now go to Mr. Sherman.
Mr. Chairman.
If you'll finish answering for the record, we'd appreciate that. We'll now go to Mr. Sherman of California. And then at this point, we'll be able to get one more question in before, I think we'll get one or two more questions in before we have to go to the floor. Mr. Sherman.
I'm surprised to hear Republicans criticizing you for visiting Europe because European standards are lower than American standards and more in tune with what they're advocating you to adopt. If our standards are too low, we end up with bailouts and bankruptcies, but if our standards are unnecessarily high, we slow economic growth. It concerns me to hear your opening testimony when you describe how these regulations are a response to the 2008 crisis. It's a little late to be writing regulations in response to the 2008 crisis. The question is, will I still be alive when you write regulations responding to the 2023 crisis? And that 2023 crisis is a direct result of you underestimating the problems of interest rate risk. You've worked hard on these regulations, but as I'll point out to you, they discriminate against the environment, they discriminate against first-time home buyers, and they discriminate against small business. Now, one of the ways they discriminate against small business is a small business, the bank has very little interest rate risk. They're short-term loans or they're adjustable rate. You buy a 30-year bond, might be very creditworthy, might not have any credit risk, it has all that interest rate risk. I'm flabbergasted that it's taken till now for you to propose regulations to say that banks have to recognize unrealized losses on held-for-sale securities. That's flabbergasting, to think that you would take an asset that the bank paid $1 million for, that the market tells you is worth only $600,000, and count it as $1 million. But half these securities are in that hold-to-maturity account, and you're not doing anything about it. Are any of you thinking of causing banks to recognize unrealized losses? And I urged this back when you were here back in March, just a few days after Silicon Valley Bank, on all mark-to-market, the losses on all securities. Are any of you considering that? Mr. Barr?
Thank you, Mr. Sherman. You raise an important question. First of all, as I said at the beginning, we're open for comment on all the issues you've raised.
You've just heard my comment.
And with respect to unrealized losses, the proposal is focused on available for sale securities, as you point out. It's the rule we have for GSIBs. We don't have that for other large banks. This would apply that approach to other large banks.
You're doing a tiny step forward when you had a massive crisis thought to be a risk to our entire economy, and you invoked that law, and you're taking this tiny step, and you're leaving on the balance sheet assets at $1 million that you know are worth $600,000. But in doing so, you're discriminating against small business. Every time a bank decides is incentivized to buy that long-term debt On a securities market, that's money they can't lend to a local pizzeria. Speaking of discriminating, against I mentioned first-time home buyers. First-time home buyers often need mortgage insurance. Your current rules recognize that mortgage insurance may not be perfect, but it's useful. Can any of you raise your hands if you want to defend the idea of having a zero value for mortgage insurance? I see no hands going up.
Mr. Chairman, just to clarify, under the proposal, our treatment of private mortgage insurance doesn't change. So it's the same approach now. Under our guidelines, private mortgage insurance can be a factor among several factors that contribute to a mortgage being considered prudently underwritten.
Well, I would hope that you would write your regulations more clearly, because many people have written them, believe that you're going to assign a zero value, and if you intend to do otherwise. Congress spends a lot of money providing these clean energy credits, and you undermine their value, you undermine congressional policy. The tax equity investments, you're going to go from 100% to 400%, making them far less valuable to banks. Is there anyone here who thinks that's in the interest of the environment? Yes.
If I may just comment, Congressman. This is, in a sense, the reason we have a comment period. We've received a lot of thoughtful comment on this subject, and we're going to give it careful consideration in the final.
I'm glad you're hearing our comments, and I hope that you would have stress tests that look at interest rates going up and down. That's the lesson of 2023. I yield back.
Gentleman yields back. Novel concept of both up and down. We'll now go to the gentleman from Missouri, Mr. Lukemeyer, for 5 minutes.
Thank you, Mr. Chairman. Welcome to our guests this morning. Perhaps the greatest threat to our financial stability is our economic ties to China and the Chinese Communist Party. Recently, I met with a market expert about the likely scenario that China will invade Taiwan by 2027 and the U.S. sanctions that will immediately be put on those folks and will follow that action. His analysis shows that our market will immediately drop 50 to 80%. I understand none of you are directly responsible for U.S. sanctions policy, but the effects of those sanctions will have a direct impact on the American institutions that you regulate. Mr. Hsu, how often do you meet with Secretary Yellen, Department of Defense, intelligence officials, and leaders of industry to develop a plan that would mitigate the fallout from this apparent inevitability?
So there are regular conversations at different levels to deal with, to assess risks to the banking system. And those span a range of topics. So sometimes it's through discussions about cybersecurity. That's often a focus for a lot of those kinds of interactions, but they also span some of the issues that you're talking about.
Okay, so do you put together a plan, or are you working with our allies with regards to a set of sanctions that will be put in place when that activity, whenever the Chinese invade?
Our expectation is that banks are prepared for a range of scenarios, especially those banks with global operations that may be impacted by issues such as the events such as the one you
My
described.
question is, and I've asked this question of Secretary Yellen and Chairman Powell in this committee, and we talked to the Deputy Secretary of the Treasury the other day about this as well. Should this happen, have we decided, are we working with a set of allies on a kind of sanctions that we put in place as per what happened with Russia? It took us 2 or 3 months to put our sanctions in place. We will, if we don't have this ready immediately, 3 or 4 weeks is going to be too late. It's all going to be over. So the question is, number one, you've answered it with regards to having some discussions across the board, but are you putting in place a set of plans for a set of sanctions that you will put in place immediately when that action takes place?
So sanctions policy is not in our jurisdiction, but we do communication and coordination for the kinds of events that you described are critical, and we focus a lot of attention on ensuring that we have those channels of communication and coordination.
Okay, Mr. Harper, are you involved in those discussions at all?
No.
Are you concerned at all about the impact that that would have on credit unions across this country whenever that action takes place?
Certainly, I'm concerned about all material actions, regardless of the source of them.
Mr. Grunberg, are you concerned about it at all? Have you talked about it with these guys, involved in discussions?
You raise a critical issue, Congressman. There are contingency plans, but for me to respond, if you don't mind, I'd like to come back to you if I want to be
Because
careful.
as you all know, the interest rate risk problem that you've dealt with back in March is going to be teeny tiny thing compared to what this would be. So I think we need to be thinking about this in terms of how we can address this for the protection of our whole system, not individual banks. Okay, Mr. Barr, last year the Durbin credit debit rule was cited by the Government Accountability Office as causing significant damage to checking account access. Research is conclusive that merchants never lowered consumer prices in response to the Fed's rule, and community banks and credit unions have borne the brunt of this harm's regulation. I believe the number is 98% of the money did not go back to consumers as they had promised. And in fact, I've got from February 2011, in an investor call, Home Depot CFO reported the rule would increase their profits by $35 million in that year. Obviously, they didn't intend to give the money back either. So are you concerned by the result of the consumers paying more for services and small banks having to merge or close as a result of losing this income stream?
Thank you very much for the question. The rule does not affect community banks. The rule is, as Congress provided, affects institutions over $10 billion in asset size. The Congress has directed the Federal Reserve to ensure that debit card interchange fees are reasonable and proportionate to a set of specified costs.
We're looking now at regular credit cards, sir, and with all due respect, I just got done talking to a bank recently that said the examiners were telling him that, yep, I realize it doesn't apply to you, but it's a good idea if you start working on the rule and start thinking about that. Next time I have a story like that, I'm going to come back to you, sir.
Please do.
This has got to stop. So, Mr. Harper, are you concerned about that rule at all with regards to the impact on credit unions?
So I'm not familiar with the study that you cited, but certainly we look at everything that does affect credit unions. Generally, as Mr. Barr pointed out, the rule applies to those institutions of
there's going to be a discussion about this as the rules some people are trying to put it together in the Senate. It's going to come over here. We've got to put a stop to this. It's not the panacea that people think it is. It is going to be a direct cost to the consumers, and it's going to hurt the small banks especially, regardless of whether you think it's only going to be the ones over 100. With that, Mr. Chairman, I yield back.
Gentleman yields back. We'll now go to the ranking member of the Agriculture Committee, Mr. Scott, for 5 minutes, and then we'll break for votes.
Thank you very much, Chairman. Vice Chairman Barr, I want you to know that I have some serious concerns with the bank capital requirements that you are proposing. And this is why. Not only with the impact it will have on our smaller farmers and their ability to access capital, but also on the increases to the cost of derivatives transactions, meaning higher prices for everyday consumers. So, Vice Chairman Barr, also, American companies like manufacturers, airlines, in addition to our small farmers, and retailers all rely on derivatives to responsibly hedge their risk for commodity fluctuations, for fuel costs, interest rates increasing. This is deep into the very soul of our business and our total economic, and all of these inherent costs and imbalances impact the average consumer. So we got a sort of a big problem here. I fear that making these hedges more costly for all of these major industries, airlines, the manufacturers, as I mentioned, will only make the cost of goods and services, food prices at our grocery stores, airline tickets, gasoline at our station, are very everyday American households more expensive. So you see, I have some very pressing concerns about your proposal. So, Vice Chair, did your analysis for the Basel III endgame proposal include the impact on this broader economy? And if American companies cannot afford to hedge their risk with the valuable tool of derivatives?
Thank you, Mr. Scott. We do think that the derivatives proposals, as part of this package of capital reforms, will improve the resilience of banks that need to provide the kinds of services that you've just described. So it's important for the economy, it's important for farmers, it's important for businesses, it's important for those who rely on derivatives, that banks can be healthy and strong in providing those services. And that is the reason for increasing resilience of the banking sector in that way.
Well, I have received some very pressing concerns about the impact of what you are doing. And are you aware of this? And if so, are there adjustments that you might make in your proposal?
We are open for any comments on the rule, including with respect to derivatives end users, that would help us better understand the costs and the benefits of the rule. And we're open to improving the rule in all ways.
Well, I hope so. And as our chairman mentioned, I'm the ranking member of our Agriculture Committee, as you may know, and our farmers are very concerned about this. I think you are aware of this. But it's good to hear that you're willing to make some adjustments, because this is a great concern to many people in our nation. Thank you. I yield back.
Gentleman yields back. We'll now recess until votes end, which will be close to noon. But when two members reappear, we'll consult with both staffs and try to get things rolling as quickly as we can when we get back. So with that, committee stands in recess. Committee will come back to order. Thank you all for accommodating our vote series. That should be the end of the vote series today. As I understand it, Chairman Gruenberg, you'd like to correct the record?
If I may, Mr. Chairman, thank you. You asked me a question earlier, and just to be specific and for clarification, in 2008, I was interviewed pursuant to a review done in response to a concern raised by an employee, and I'm not aware of anything that came out of that review. But since you asked the question earlier, I just wanted to respond clearly for the record, and we'd be glad to provide you any additional information relating to that.
Thank you. Thank you, and thank you for consulting with counsel and coming back and correcting the record. Anybody else? I'm trying to be lighthearted. All right, we'll get back to order here. Next up is the Investigation Subcommittee Chair, Mr. Huizinga of Michigan, for 5 minutes.
Thank you, Mr. Chairman, and Mr. Gruenberg. I appreciate that clarification. You've had a long career at the FDIC, a long career in Congress. As a staffer in the Senate side, as a former staffer myself, I know sometimes that's both good and bad. But I was going to ask, and am going to continue to ask, much of those incidents that were reported in the Wall Street Journal happened under your watch directly. 2011 to 2018 was your first go-around at FDIC as chair. The article listed incidents in 2013, 2015, 2017, 2018. Were you made aware of the misconduct that was going on at the time referenced in those articles when you were chairman?
No, Congressman. When cases like that come up in which there is a complaint filed and then a review done, an investigation done, and a disciplinary action taken, that would be done through our legal division. And
so the legal division does not talk to you at all. Does that seem right to you? That seems a little odd to me.
I think the notion is that to the extent these were adjudicatory matters between employees, the board is generally kept out of that.
Okay, I think the real question and the assertion behind this article is the systemic element of this. You initiated an independent review after that article came out. That was kind of interesting. In your opening, you said you have no higher priority than ensuring FDIC employees work in a safe environment and feel valued. To Ranking Members Waters, you responded that you want to hold individuals accountable and, quote, will be entirely transparent. You weren't really transparent earlier. You've corrected the record now on that. I'm not going to ask you some of the salacious things that Senator Kennedy did, but I do intend to ask you to clarify and amplify what happened, I think, as you said, in 2028. Because, Mr. Chairman, my experience is that no, it was 2008 but my experience is that culture starts at the very top. And so you're saying that there was some accusation and review and presumably a report of some behavior. Is that correct? Was there a report that was issued?
I believe so, Congressman.
Okay, and you'd be willing to share that, have us be able to go into the legal department and HR and IG and whoever else we need to talk to?
Yes, sir.
Okay. Was there an NDAA signed with that or a settlement that was a part of that?
No, sir.
So there was no cash settlement, there was no non-disclosure that came out of that?
No.
So we could talk to whoever made the accusation as well?
Yes.
All right. Well, I appreciate that. We will intend to do that. So thank you for that clarification. My remaining time, I want to turn to Mr. Barr. Yesterday, along with my colleagues, Representative Muser and Representative Mooney, we sent you a letter about the totality of the rules currently being proposed or finalized by the Federal Reserve and other regulators. This is something that we talk with the chair of the SEC on a regular basis about. As a quick example, Basel II rule is more than 1,000 pages long, with very little of it focused on the aggregate effect of these proposals on the ability of financial institutions to serve their customers and to support economic growth. Do you or anyone at the Fed, for that matter, have a sense of the cumulative impact of the massive number of regulations that have been recently finalized or that are in the pipeline, and what they will have on consumers' access to bank loan products? And if you're not familiar with the letter, I've got a copy here. I know it was sent yesterday.
I did take a look at the letter very quickly, so I don't have a detailed response to you, but we do look at the effect overall of our rules. We don't anticipate that the effect of the capital rules that we've proposed are going to have a significant effect on credit conditions, on lending in the United States.
Who is actually doing that? Who's giving that serious thought about all these changes that are going to happen at the same time, and somehow, banks and how they fit into that economy? Is that you? Do you have economists that are looking at it? Who is actually providing that analysis?
I'm ultimately responsible for that. I do have many staff people who are working on analysis of all of it.
And will you share, and I think this was something that was pursued yesterday at the Senate, will you share that analysis with us? Not just what you put in the report, but the actual analysis that leads you to those conclusions. Will you provide that to us? That is what we've asked for repeatedly.
The analysis that is in the proposal is the analysis that supported the rule. We'll, of course, continue to do that work. We're gathering comments and information. We will analyze that, and we'll make that information.
That's not the answer, but I'm glad to hear we're going to have 15-day responses, Mr. Chairman, so as we've had with the ranking member. We look forward to hearing from those.
Well, the ranking member set the tempo. We'll now go to the gentleman from Missouri, Mr. Cleaver, for 5 minutes.
Thank you, Mr. Chairman. You probably don't get a lot of this, but I'd like to thank the Federal Reserve, the OCC, FDIC for the work that you've done on CRA. I've had a chance to meet with all of you to discuss my concerns and also look for ways in which CRA could be updated and be more of a factor in affordable housing. And I appreciate all of the work that you have done, the collaboration that has occurred, and I am excited about it. As you know, the Trump administration, the OCC had attempted to unilaterally impose a harmful rule that would have undermined the Community Reinvestment Act, and it would have been just a paper tiger in terms of its ability to combat modern-day redlining. So, thank you very much for all of the hard work that you've done. I appreciate it very much. I don't know how familiar you are with, I'm probably the foremost expert on monsters in Congress. I've studied them all. And Frankenstein, of course, is unique. Mary Shelley created him in the early 1800s. It's a Gothic novel. I don't want to go into too much detail. I know you're interested, but I'm not going to go into detail. Mary Shelley talks about how this monster was created and made, and then turned on the villagers. And about 15 years ago, the chairman, the ranking member, and I were here when Frankenstein walked through that door, right, this one, and told us we were on the verge of a worldwide economic collapse. And we had created that monster by lackadaisical views of what was going on with the big banks. And so he came in to wreak havoc. And then a few months ago, the Silicon Valley Bank caused me to think that people are trying to piece back together Frankenstein again. I think if banks are insufficiently capitalized, particularly these banks that are just dealing with these tech companies, these startups, they can create Frankenstein. I just want to find out from you if you think that the banks are sufficiently capitalized and that Frankenstein is not going to return. No, the next book was The Return of Frankenstein. I mean, you probably didn't know that, but.
Thank you very much for the question. I do think overall that the banking system is sound. We have identified areas that are in our capital proposal where we think banks should be more resilient even than they are now. We hope to see these proposals through the comment process to gather information, to learn more about what people think about the capital rules. But in general, we think these risks are not appropriately addressed with risk calibration in our current approach, and they could be improved.
So are you saying that the Silicon Valley issue, those 3 large regional banks that, in my estimation, could have started bringing down this economy again, or are you all saying that that's not going to happen, that everything is now at a level, even though the large banks, as you probably know, are on the low end of what is socially optimal in terms of the balance, the cost and benefits to prevent such a thing in the future. So even though they're dropping, you're still comfortable?
I think in the case of Silicon Valley Bank, the depositors looked at the bank and judged it to be insolvent. And one of the steps that we're taking in this capital rule is to provide a rule that says unrealized losses on available for sale securities need to be included in capital. So that provision of this package would address the concerns in that particular case.
Thank you, Mr. Chairman.
Thank you. And we'll now go to the gentlelady from Missouri, Ms. Wagner.
Hi, thank you, Mr. Chairman. Vice Chair Barr, your Basel III Endgame proposal would significantly increase capital requirements on the capital markets activities of the largest U.S. financial institutions. These increases will negatively impact U.S. banks' ability to conduct critical market-making activities, harming further the U.S. economy. Considering that the largest U.S. banks make up roughly 50% of securities underwriting, what specific analysis did you conduct to determine the impact that your proposal would have on securities underwriting?
Thank you very much for the question. The analysis in the rule supports a better risk calibration of a range of trading activities that the largest banks conduct. The risk calibration would make those banks more resilient so that they're able to actually provide the services that you described that are so vital for our economy. We are open to comment from banks and from the public. If they believe that the risk calibration is not correct, we very much welcome comment on it.
Well, I think that everyone thinks it's not correct. Your proposal would also limit U.S. banks' ability to participate in derivatives, securitization, and securities lending. Why place these punitive capital requirements on the trading desks of banks?
Thank you very much for the question. What we have learned over the course of seeing the experience of how banks manage these risks is that some of these risks can cause serious losses to the banking sector and harm the American economy, as we saw in the global financial crisis. So we want to make sure that all the activities a bank undertakes, including the activities that you described, that those are done in a safe and sound way. And capital is the absolutely essential element to have to make sure that banks are operating safely.
And your proposal is going to limit that greatly. You know, access to credit, or loans essentially, is a key driver of the innovative and competitive nature of the American economy. Credit helps start businesses. It allows them to grow and to invest in anything from new equipment, facilities, technology. It helps create jobs that would not have existed otherwise. Chairman Gruenberg, do you agree that the Basel III Endgame proposal will lead, as you've even heard from left-leaning and progressive commentators, to higher costs of credit and less credit availability for low-income and traditionally underserved communities?
Thank you. Thank you for the question, Congresswoman. First of all, I think it's important to recognize that this is a proposed rule, that we're receiving comment on a range of these issues, and we'll certainly give them careful consideration, and I certainly expect.
I'm aware of that. Could you answer my question?
So I think we're going to address some of the concerns raised specifically on the credit side in the rule, in the final rulemaking.
Very concerned about the credit side and availability for literally the low-income and traditionally underserved communities here.
And that's been, if I may say, particularly raised in regard to the risk weights for mortgages. We've received comments on that. We actually have language in the preamble discussing that issue with alternatives to be considered that we're seeking comment on, and that'll be a focus of attention in the final.
I hope so. Vice Chair Barr, the U.S. implementation of the Fundamental Review of Trading book, the FRTB, along with the global market shock component of the Fed stress tests, are essentially a double count of capital requirements, forcing U.S. banks to have enough market risk capital to survive 2 financial crises in a row, whereas European banks only must have enough market risk capital for 1. Does the Federal Reserve believe that U.S. markets are twice as risky as Europe, or that European banks are undercapitalized?
Thank you for the question. The proposal does not double count risks in the banking system. The risk-weighted asset proposal that we use under this proposal is used to set minimum capital levels, and the stress test is used to set a stress capital buffer. Those are done independently. It is not in my judgment,
cumulatively, it is a double count. You've got the Fed stress test along with the FRTB. It is a double count for U.S. banks and puts us in a competitive disadvantage, sir.
As under our current rules, the risk-weighted approach, the static approach, is used to set minimum requirements, and the stress test is used to measure the stress capital buffer.
My time is expired, but I hope you're going to take this into consideration, because you're putting us at an extreme competitive disadvantage with Europe. I yield back, Mr. Chairman.
If the witness would answer for the record. We'll now go to the gentleman from Illinois, Mr. Caston, for 5 minutes.
Well, thank you, Mr. Chairman, and thank you, Mr. Vargas, for your perennial graciousness. So I appreciate the work that all of you are doing on the Basel proposals. Obviously, we're keen to see the final details, but I am generally supportive of a robust and well-capitalized banking sector. But I do have some concerns I want to raise about the tax equity provisions, specifically as they relate to clean energy. I see some heads nodding, so hopefully this is not new information for any of you, but just for the millions of viewers we have right now, the proposed rule would quadruple the capital requirements for banks that make tax equity investments. And I'm particularly concerned about that as it may frustrate the intent of the Inflation Reduction Act, since the clean energy provisions relied so heavily on tax credits. Chairman Grunberg, Mr. Hsu, Vice Chair Barr, I think I see you nodding, but you're all familiar with this provision of the proposal? Yes? Okay, the record will show vigorously nodding heads. Can any of you speak, did you contemplate the renewable energy development consequences when you were developing those provisions of the clean energy tax equity credits? Would anybody like to comment?
I'd be happy to address the question. So we don't have special provisions in the capital rules for different kinds of either renewable energy credits or other types of things. The tax credits are treated the same as other private equity investments. Now, we are open to receiving public comment on this. We've heard a lot already about it. The kinds of comments people have been saying to us, which are the kinds of comments that are appropriate for us to take into account, is that these types of instruments have lower risk than other equity investments because the investor is repaid through the proceeds of the tax credit.
Okay.
That's the kind of evidence that we would consider in thinking about whether the calibration is appropriate.
Okay, I want to agree with the second half of what you said and just challenge the first half a little bit, because under the proposal, the tax credits for if you use tax equity to fund tax credits for low-income community housing support, there is no change in the risk weighting from the current 100% level. if you use tax equity to fund tax credits for clean energy development, there's a 4 times increase in risk weighting. So I would challenge the assertion that all tax equity is treated the same way. There are some differences within the tax equity universe.
Yes, there is a separate statutory provision with respect to low-income housing tax credits that are treated differently under the rule for that reason.
Okay, well, let me come back to that because, Mr. Hsu, I just want to clarify something with you. In 2021, the OCC established specific criteria for tax equity that said that tax equity investments are, quote, the functional equivalent of a loan in order to qualify under OCC guidance. Do I have that right from the 2021 OCC guidance?
I think so, but I'd like to get back to you on that.
Okay. I'm reading from a report that the OCC issued that essentially said in order for tax equity to be treated, it had to be the functional equivalent of a loan. So it seems like under OCC guidance, that's already been established as the comparable point. Mr. Grunberg, you had something you wanted to add?
I just wanted to comment that in terms of the renewable energy tax credit, I think this is a pretty good example of the value of a comment period. You know, I'm not sure in crafting the proposed rule, we fully appreciated the impact here. And I think the feedback we've received has been helpful, and I think will
That's great.
Influence the final
Well,
rule.
I'm glad to hear that, and I just hope you will all commit to considering alternatives that accurately reflect the risk and are consistent with prior OCC guidance. I see heads nodding on that as well, so I'm glad to hear. Last thing I want to raise in the little time we've got left, in talking with clean energy developers and talking with banks, we are hearing that banks are already starting to slow down their investments in clean energy in this space because they are anxious about the potential need to build capital reserves. I'm curious if you all are hearing that in the pushback, because we're certainly hearing it from the industry.
I don't know the answer to that question.
Yeah, for what it's worth, I have not heard that, but we can.
Okay, well, I hope that shows up in the comment record then, and not just people calling their friendly member of Congress to push back on it. But I raised that just in the time because I understand you've got a process. I understand there's a phase-in to go through, but given the slowdown already, an affirmative statement of intent earlier on would be very helpful.
The gentleman's time has expired.
Thank you. Yield back.
We'll now go to the chair of the Small Business Committee, Mr. Williams of Texas.
Thank you, Mr. Chairman, and thank all of you for being here today. And I'm a small business owner from Texas. 52 years I've been in business. I'm a car dealer. Every day I've been involved. I owe money to a bank every single day for all that period of time. And I'm really worried about where we're taking our banking system that would affect Main Street. I'm worried about my bank having been able to loan me money when I need it. So over the last year, our nation's federal banking agencies have been bombarding our financial system with excessive regulations and dangerous proposals like Basel III, long-term debt requirements, and climate risk management standards. It's also alarming that our banking agencies are rolling out these types of proposals in a rushed fashion without considering how these combined regulations and requirements might impact innovation, limit access to capital for Main Street for small business, and threaten economic stability. So Vice Chair Barr, you claim that Basel III proposals contain a meaningful analysis. However, from what I see, the Basel proposal is over 1,000 pages long, and less than 20 of those pages cover an economic analysis. So given that proposal will overlap with numerous other existing requirements, I find these 20 pages insufficient for a complex proposal like Basel. So why do you keep ignoring Congress's request for a full economic analysis?
I believe that the proposal contains economic analysis that supports the rule. We obviously are open for and welcome to comments, happy to receive analysis if people disagree with us, and to take that into account in our normal notice and comment rulemaking process.
Now, I've been actively working with members on this committee and the Committee on Small Business to be the voice for Main Street in the rulemaking process. Main Street America, the whole, what our country is all about. And Mr. Barr, earlier this year, I sent you a letter with my colleague from Pennsylvania, Mr. Musser, which expressed our legitimate concerns that Basel III will significantly impact America's ability to access reliable credit and increase overall borrowing costs. In a time where interest rates are already making it harder for small business to access capital, this proposal would be disastrous and couple it with the economy we got now, it would stop things. So again, to you, Vice Chair, will you abandon the provisions calling for elimination of banks' use of supervised internal models in determining capital requirements?
Thank you for the question. We do not believe that the proposal will have a significant effect on credit conditions. Most of the proposal deals with trading and other non-lending activity. Small banks are not part of this proposal. They're responsible for doing lots of small business lending. And even with respect to the small business lending that big banks are doing, the proposal keeps the current approach with respect to capital treatment for small banks and provides some opportunity to get a lower risk weight if small bank lending is part of a diversified portfolio, for example. So we do not anticipate the kind of effects that you're describing, but we are, of course, open in the comment period to hearing that. If we need to make adjustments to our approach, we're very open to doing that if it's supported by the analysis that we get.
Well, a good analysis is talking to Main Street America. The banks are nervous. The banks are already getting scared to death of this. So the Federal Reserve recently released the Community Reinvestment Act rule, which was nearly 1,500 pages. This is a massive overhaul for smaller banks in my district that do not have the legal and compliance teams to deal with the undertaking that comes with 1,500-page rule. Community banks are already struggling under the current regulatory agenda. We should not be adding more burdensome rules that will increase compliance costs. They're hiring more compliance officers than our loan officers. Again, that affects Main Street. We should be focused on allowing these banks to thrive, not trying to regulate them to death and, frankly, let them compete. So quickly, Mr. Grunberg, could you explain how federal banking agencies are working to educate smaller community banks on compliance and not just throw a 1,000-plus page rule at them and expect them to perfectly comply? Because what will happen, like all small businesses, they will decide to get smaller rather than bigger because they fear all these regulations. And then again, that affects Main Street, that affects me, and then it affects people being able to hire people, et cetera. So could you please answer that question?
Yes, Congressman, thank you. Thank you for the question. We were quite sensitive in the Community Reinvestment Act rulemaking to its impact on community banks. So all community banks with assets under $600 million, which is over 3,000 community banks, will have no regulatory change from their current treatment under CRA. The new rulemaking will not impact them at all. And for banks between $600 million and $2 billion, which is, frankly, covers most of the additional community banks, they would have only a marginal change and no additional record keeping. So I think as a general proposition for banks under $2 billion, which is the large majority of community banks in the United States, there should not be a
Gentleman's
Time's up. Thank you very much.
Gentleman from Connecticut, Mr. Himes, is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you all for being here. Vice Chair Barr, it's good to see you again. You're sensing and hearing a lot of confusion on the part of members around the proposed rule. I want to limit my comments to the question of additional capital, and I'm going to hand you the bulk of my time, but I want to guide how you answer this. We're in a world of confusion here. We saw a governor's vote that was split. We heard the chairman himself elucidate some very serious concerns. The first line of your testimony today was our banking system is sound and resilient. And so a lot of us are struggling to see the clear need for additional capital. And by the way, having lived through 2009, 2010, if that need is clear, you will have an ally sitting right here on that issue. But we're struggling to see the need. And I heard what you said to the chairman. It was it's in there in the preamble. I've read the preamble a whole bunch of times. It refers both to quantitative impact studies as well as to the preponderance of literature. This committee, we deal with flood insurance. I'm struggling for analogies here. This committee is used to seeing proposed FEMA flood maps where in a 100-year flood, and we get what a 100-year flood is, the water gets to here, and that's bad because this house is there. I think we need that kind of specificity. You will have, I guess, run scenarios, and I'm thinking of those flood maps, and what we really need to hear is that if we saw, conditions that mimicked 75% of the adverse change in 2008, this is what would happen. So again, just to guide the 3 minutes I'm about to hand you, it would really be great to hear described in terms that we can understand it, the quantitative indications, but also save a little bit of time to talk about the academic literature. Academic literature can be supported, it can be chosen to support lots of things. So give us a sense for how we can have confidence that that academic literature also supports the case for additional capital.
Thank you very much for the question and the opportunity. And start with the broad frame. As you know, capital is really key to a resilient banking system, one that can serve households and businesses both in good times and in bad times. Banks with strong capital lend more throughout the economic cycle, and capital helps to prevent financial crises and to mitigate their impact. Financial crises can crush American households and shutter American small businesses. The costs of a financial crisis range from 20% to 100% of GDP, or $5 trillion to $25 trillion for the United States. The proposal we put forward focuses on stronger capital rules for trading and other non-lending activities where banks have had large losses. Operational risk capital covers risks from the loss, for example, from rogue traders, from fraud, from other illegal activity and securitizations, illegal sales practices, brokerage, and other activities where banks have had large losses. On the trading side, banks have had significant losses from trading and other derivatives activities. In the global financial crisis, as you know, for example, in just 1/4 of the global financial crisis, banks lost $38 billion from their trading and derivatives activities. So on the credit side, the approach takes a standardized but risk-sensitive approach to credit. We don't believe that that will result in significant changes overall on the credit side of the House. If you look overall at the proposal, it's about a 2 percentage point increase in required capital. 30 basis points, or 0.3% of that, relates to credit. That would translate for an average loan to about a 0.03 percentage point increase in funding if all of the cost of that additional capital were passed through, if there were no competition at all. That's what the result would be. Overall, we think that this approach is a reasonable one. Because of management buffers, most banks already meet the capital requirements today. The ones that don't could build capital within 2 years while maintaining dividends. So in our judgment, the proposal makes the capital system more consistent, more transparent, more risk sensitive. At the same time, we recognize people have different views. That's why we're
Mr.
all here
Barr,
today.
let me cut you off because I only have 20 seconds left. I hear everything you just said, and I understand. I've been through a bunch of these crises. I understand that more capital will make a more safe system. And to some extent, the burden's on the regulator. If you start your testimony with our banking system is sound and resilient, period, no comma, but we didn't hear articulated what we're so hungry for, which is why the optimal capital proposal involves considerably more capital. And I would just ask you, please, just to sort of try to resolve some of the arguments here, to provide whatever quantitative analysis indicates that more capital would be better.
Thank you.
And yield back the balance of my time.
Gentleman yields back. Gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes.
I thank the chairman. I thank all of our witnesses for your patience as we were voting. I'm glad this resulted in me getting to make it this far into the queue. You know, we spent a little bit of time already talking about the amount of reserves that are being required, but Mr. Barr, my question is for the Federal Reserve, do you consider payment of interest on excess reserves monetary policy or regulatory policy?
Just to clarify, the proposal we have in front of us with respect to Basel is not a proposal that would increase reserves in any way. It's about...
Not my question.
I'm sorry.
Not my question. My question is, when the Federal Reserve pays interest on excess reserves, which they do, over and above what they're requiring, they pay interest on it for the deposits. Do you consider that monetary policy or regulatory policy?
It's clearly monetary policy.
All right, thanks for your interpretation. What is the status of your work on central bank digital currencies?
We're in a very early phase of research exploring different aspects of central bank digital currency. We've not made any decision at all about whether to recommend a retail central bank digital currency. If we were to have such a recommendation, we would come see the Congress and the executive branch to get your authorization to proceed.
Yeah, so not only is it not authorized, I guess I took notice, and a lot of people did, when the Federal Reserve was actually hiring developers to write code. So is there actually a design for what you're trying to build? Is this Death Star already built, or is it just under consideration?
As I said, we've made no decision to move forward with a retail CBDC. If we did, we would seek authorizing legislation for that. We are conducting basic research to try and understand the technology and make sure that we wrap our arms around it.
All right, thank you. Acting Controller Sue, the 2021 Interpretive Letter 1179 issued by the OCC clarified your position that banks may provide digital asset custody services, hold stablecoin reserve deposits, and allow banks to use ledger technology and stablecoins to engage in payment activity. The OCC provided several firms conditional approvals which have now expired under your leadership. Can you comment on the impact of these expirations? What kind of impact have they had on banks and firms that invested in developing the ability to provide services to digital asset companies?
Sure. Thank you very much for the question. So our mission and our job is to ensure that all activities done in the federal banking system by national banks or federal savings associations is safe, sound, and fair. And that includes any crypto-related activities. Crypto, as you know, has a number of risks associated with it. And so part of that interpretive letter was just to highlight there are some risks with that. If you or a national bank are going to engage in that, you have to demonstrate that it can be done safely and soundly and fairly.
All right, we'll continue to have input on that. Obviously, our committee's done some work on digital assets. We'd like to provide more clarity, but frankly, I would have liked to have seen the continuity that was there in the space, and I think would have been great for our markets. When you look at things that are good for our markets, the FDIC and the Fed have both been busy shoring up some of the credit risk that's been out there. One of the things that has worked pretty well, Ohio is home to almost half of the privately insured credit unions. Are there plans to give them access to the bank term funding program that is available for banks, but not credit unions currently?
We do not have any plans to change the terms of the bank term funding program at this time.
All right, thanks. I think the last thing I'd conclude on, Mr. Barr, really is for the Fed. You see, certain things that the Federal Reserve's involved in heavily are the regulatory lane, of course, your lane, and this is a Prudential bank regulator hearing. The four of you are lined up there, and I really feel like the function of the Prudential regulatory activities of the Fed should be separated from the monetary policy functions. I think it should be clearly subject to appropriations. We're working on the Federal Reserve Oversight Accountability Act that would do just that. And historically, folks who've held your role haven't favored that approach because it would provide more accountability to Congress and an actual appropriations process and whatnot. But I guess, what's your take on that as a path?
I think congressional oversight is absolutely essential. I would not pursue the particular legislation that you've described.
Thank you. My time's expired, and I yield.
Well, I'll go to the gentleman from New York, the ranking member of the Foreign Affairs Committee, Mr. Meeks.
Thank you, Mr. Chairman. I'm concerned about the impact that the Basel Endgame proposal will have on access to mortgage options for first-time, minority, and low to moderate income home buyers. Vice Chair Barr, during your testimony before the Senate Banking Committee yesterday, you acknowledged that you are mindful of the concerns raised about the impact that risk weight proposals could have on mortgage access for prospective Black and brown homeowners who may be creditworthy but may not be able to afford the traditional 20% down payment. How do you plan to address the potential intensification of unequal access to mortgage credit for minority and LMI households brought on by the proposal?
Thank you, Mr. Meeks. We are in the middle of a proposal phase. We're in the gathering of public comments. we're open to looking at all the ways that the rule might be improved, including the ways that you've described. We very much welcome that public comment. We asked for particular questions in the preamble of the rule to make sure that we got good public comment on how to address that. We'll have to wait and see the actual comments and make an analysis and evaluation of those comments before making any decisions about how the final rule should address it. But I very much hear the concerns and appreciate the public comment on them.
And let me just also add on that, because I also understand that if regulators make targeted fixes to the proposal, I just want to bring up other issues that could come up, like that's less obvious aspects of the proposal that could have similarly a dramatic effect and consequences to mortgage access, because I'm concerned about mortgage access completely. For example, I'll give this as an example. Banks, which often make affordable mortgages and go on to sell them to GSEs for a fee, would be punitively treated by operational risk capital requirements associated with that income. So can you speak to that issue?
The proposal does require operational risk for a range of market activities, including securitization activities. The underlying credit with respect to mortgages sold to Fannie or Freddie does not change from current law. And we are, of course, open to hearing concerns in this space as we are throughout the rule. And if there need to be adjustments, we know how to make those adjustments. So appreciate the comment.
Yep, and I just would hope that you could commit to conducting a truly holistic view, a review, I should say, that considers the impact of the proposal's risk weights and its operational risk requirements posed for affordable mortgage lending. I think that's tremendously important. Can you do that?
Yes, we are committed. I can speak for myself. We're open to all kinds of comments on all aspects of the rule, including the one that you just made.
And Mr. Sue, you and Vice Chair Barr both referenced the modernization of CRA in your testimony. And I'm curious how you view the intent of the new CRA interacting with the proposed changes to capital requirements.
Well, I think about them separately in the sense that the purpose of the CRA is to really address redlining. And as you know, the law was passed in 1977. With the modernization, is to really catch that up to where the banking system is today and how it operates. And I think we feel pretty good that this final rule that we recently adopted will help do that. I want to echo what Vice Chair Barr said with regards to the Basel proposal. We understand, we hear the concerns with regards to mortgages, and we are open to all the comments on that and making improvements as warranted.
I just want to say it's absolutely key and essential. You know, there's so many individuals, low and moderate income families, great credit ratings, they just can't afford the 20% down payment. And to deny them that is to deny them the American dream and the access to create wealth, because for most people, that home is the greatest investment that they will make, and it is something that helps reduce the income gaps and helps wealth. So I would hope that we make sure that you take every consideration as you're looking at the proposal to make sure that's included and not bypassed and not looked at, because it's absolutely key for many Americans. And I yield back the balance of my time.
I'll recognize the gentleman from Tennessee, Mr. Rose, for 5 minutes.
Thank you, Chairman McHenry, and thank you to our witnesses for taking time to be with us today. Mr. Barr, as I am sure you are aware, there are multiple Chinese entities that are members of the Basel Committee, such as the China Banking Regulatory Commission. Given that Chinese entities sit on the Basel Committee, how can we be sure that the government of China is not playing an outsized role in setting international standards that could ultimately be adopted by the Biden administration-appointed U.S. regulators like yourself?
Thank you for the question. The United States participates in these organizations. In general, those organizations operate by a broad consensus. if we found that there were any issues with respect to international approaches to an issue that we didn't think make sense in the United States, we would not implement them in the United States.
Thank you for that perspective. Mr. Barr, the Basel Committee on Bank Supervision uses peer review processes to monitor whether jurisdictions are complying with the Basel Committee's recommendations. The federal banking agencies participate in these reviews. For example, the Federal Reserve is peer-reviewed by officials from some foreign regulatory institutions for compliance, and the Federal Reserve devotes resources to participate in the compliance regime. Are you aware of any publications or reports from any of the federal banking agencies informing the public or Congress about this peer review process?
I'm not sure I know the answer to the question. I'll have to get back to you.
Thank you. Please do. It appears that the government has created moral hazard by encouraging banks to take more risk with deposits they receive, given the decision to provide blanket deposit insurance for failed banks using the systemic risk exception. Mr. Grunberg, do you agree with that, and can you explain why?
Thank you, Congressman. It's a very important question, if I may say. I think the answer is yes. The decision to protect those uninsured deposits at the two banks that failed in March was a consequential decision. Those were uninsured deposits. Those depositors made those deposits without an expectation of deposit insurance. The law does provide authority to the Federal Reserve and the FDIC, together with the Treasury in consultation with the President, to set that aside and protect those uninsured deposits if we believe there's a genuine risk to financial stability. And I think the fact is we had a tough judgment to make back in March, whether to not protect those uninsured deposits and run the risk of a contagion effect impacting other institutions with potentially additional failures, or to intervene utilizing this extraordinary authority in a limited way for these two institutions. And I think the judgment was at the time that the financial stability risk was real, the contagion effect was impacting other institutions, and this was the prudent thing to do. In retrospect, I think that was probably the right call. I think the system has stabilized since. I think there are consequences to that decision, which is really why it's quite important for us to follow up in regard to a number of regulatory matters to try to offset the moral hazard created by that decision. But it was a tough call, but in retrospect, I think the right decision to make.
So in light of the regulatory failures that perhaps were made evident by those failures, what can we do? And so obviously, hopefully that leads to better, more careful scrutiny going forward, but what other things might you all do to limit that moral hazard?
Well, I mean, we learned some big lessons about liquidity risk from this episode. I think we're now all quite focused on supervisory attention to interest rate risk, to uninsured deposits, to accumulations of unrealized losses on the balance sheets of banks, and on rapid growth, and the need to escalate supervisory matters and to compel compliance if the circumstances require it. So I think there are a number of supervisory actions we can take to mitigate the consequences of the decision. I do think, if I may run it, the long-term debt rule to
Thank you. If my time's expired, and so thank you for that answer. If you want to expand on it, we certainly would appreciate it for the record. Thank you. I yield back.
The gentleman from Illinois, Mr. Foster, is recognized for 5 minutes.
Thank you, Mr. Chair, and to our witnesses. Vice Chair Barr, I'm going to have another stab at doing something as quantitative as I can squeeze out of the panel here, having to do with the Basel Endgame stuff. You know, you gave a speech in Nashville to the American Bankers Association recently where you had some, what I thought, very interesting numbers on this. where you started out by you ended up by concluding that the proposed increase in capital standards would only amount to a rise of 1.5 to 3 basis points in the cost to fund each dollar of a typical loan portfolio. And so for those of you who are not, basis points are, they're known to scientists as 10 to the minus 4 is 1 basis point. So 3 basis points is 0.03% for those who deal in percentages. And so I was just wondering if you can sort of walk us through the chain of logic and the numbers because I hear on one hand that, it's a 20% increase in the capital standards, and then somehow that ends up in your conclusion of your speech to 1.5 to 3 basis points. So if you could sort of walk us through those numbers solely enough that we can follow the numbers, it would be great.
Thank you very much for the question. So if you take overall the capital increases in the proposal, they amount to about 200 basis points or 2%. Of that 2%, 30 basis points is
Okay, just a minute.
attributable.
So the 20% that gets quoted means it's 20% of the capital that's sitting around 10% now.
Right, you can think the overall average increase is 16% of 12%, so about 200 basis points.
Right.
So of that 200 basis points, about 30 basis points are associated either directly with credit or with the operational risk that comes with credit provision. So that together is 30 basis points. That would be the increased risk-weighted assets, or you can translate it, into capital terms. If you assume that the cost of equity is about 10 percentage points higher than the cost of debt.
Okay, now is that a standard assumption, or is that
It's
something you made up?
a conservative assumption. You could say it's a little bit higher or a little bit lower, but it's a conservative assumption. So if debt were 4%, equity would be 14%.
Okay, and that pretty much just comes from the fact that if a bank, the bank can make the loan, but you can force them to either issue equity instead of issuing debt.
That's correct. It's
And
just
so
a
that
choice. The loan is funded.
Banks prefer to issue debt because you pay interest, whereas equity, you pay dividends, and then there are tax implications and so on. So that's a generally reasonable number. That's 10% increase when you force them to issue new equity instead of new debt to issue a loan.
Yes, that's
That's the
correct.
10%, okay.
That's correct. So if you took 10% of 30 basis points, that's 0.03 percentage points. So a typical loan, an average loan in that portfolio would cost 0.03 percentage points more if there were no competition at all and the bank fully passed through that increased cost to the borrower.
Okay, and so that in reality, I guess there's sort of two numbers there. This only applies to the biggest, couple dozen banks.
Yeah, the largest 37 banks.
37 banks, 3 dozen. Okay, and to a scientist level of accuracy. So that then presumably some of that business will just shift to smaller banks or to non-bank entities.
It's
so
possible. It could be that some of the cost is passed through. It could be that competition forces the bank to internalize that cost. It could be that some smaller banks do more small business lending.
Right, and then there's also the Mogliani-Miller effect, where presumably if a bank is forced to carry more capital, that whoever loans them money will charge them a smaller interest. Is that included in this, or is that another factor that will?
That is not included in this calculation. So if you took a pure view and said of the Mogliani-Miller theorem, you would say that the bank should be indifferent between debt and equity, and as equity grows, the debt becomes cheaper, but that's not in this calculation.
Okay, and just in my last 20 or so seconds, Acting Controller Sue, you gave recent remarks talking about your need to have visibility over not only third-party vendors, but deeper into the stack. Can you just say a few words about that?
Sure. So the banking system and the provision of banking services is evolving quite a bit, and especially with regards to banks and non-bank partners like fintechs. And then the fintechs themselves also have partners. And so currently, we've got visibility, a lot of good visibility into bank fintech partnerships, and we recently put out some guidance, interagency, regarding best, risk management practices for that. But as the system evolves and this landscape evolves quickly, we do need to keep an eye on these longer chains, if you will, almost like supply chains for banking services, to make sure that the banking system is safe, sound, and fair.
Gentleman's time has expired, and we're pushing up a hard stop, and 1:30 is a hard stop. We'd pledged. We've got members in the room who still want to ask questions, I know, but we'll accommodate you at the next hearing. And so we'll go to Mr. Lucas, the chair of the Science Committee.
Thank you, Mr. Chairman. And as a courtesy from one committee chairman to another, I yield whatever time you may need to you from me.
I thank you. Mr. Vice Chair Barr, I just wanted to give you an opportunity if you wanted to correct the record about compensation. Have you attended any Bank for International Settlements meetings?
I have attended Basel Committee meetings.
Okay,
yes.
Basel, okay. We had an answer from Chair Powell that said the board does receive certain payments from in this answer, Bank for International Settlements related to attendance at Board of Directors meetings. I'm just trying to figure out what this is.
I apologize, sir. I don't know anything about that.
So you didn't receive any compensation for your participation at Basel, no reimbursements from them or compensation from them?
Correct.
Okay.
I don't know the BIS rules of procedure.
Try to figure it out. That's why we ask. That's why we ask these questions. We'll have follow-up on that, obviously. Thank you. Chairman Lucas, yield back to you.
In my remaining time, the Federal Reserve has maintained that U.S. banking system is sound and resilient with strong levels of capital liquidity. Yet the Boswell endgame proposal is set to substantially raise capital requirements. That's been discussed here, which will increase cost and reduce access to capital. Chairman Powell even discussed in the Fed's board meeting that the proposal exceeds what is required by the International Boswell Agreement and goes further than jurisdictions around the world. So Vice Chairman Barr, since the Boswell proposal has not been directed by Congress, is there a particular weakness in the banking system that this proposal is attempting to address? What are we trying to fix?
Thank you very much. What we've experienced is that the risk calibration that is used for certain bank activities doesn't really match the kind of risk that we've seen in the past through historical experience. That's particularly the case for things, for example, like the trading desks and derivatives activities, where the risk calibration doesn't really cover tail risk from extreme events like those we saw in the global financial crisis. So the rule is tailored to try and address those kinds of risks.
So when financial regulators implement massive policy changes under administration, it creates significant uncertainty with businesses and consumers. So again, Vice Chair, you've indicated that the final Boswell package will have broad support across the Board of Governors, and you have reassured the public that the Federal Reserve is a consensus-driven organization. After reviewing the comments and doing the appropriate revisions, is it your intention that the final rule have unanimous support of the board?
I can't promise what my fellow board members would do. I hope to seek broad consensus across the board, but each individual governor and, of course, the chair makes his or her own decisions about whether to support a rule or not support a rule.
I'd like to shift my focus to one aspect of the Basel proposal, the impact on end users like small businesses and ag producers that employ derivatives to manage risk. The proposal would impose higher standardized capital requirements on derivative transactions, despite Congress and this committee consistently acting in a bipartisan basis to protect derivative end users from increased cost. My colleague David Scott discussed this with you earlier today. It seems like you're willing to study the impact on agriculture and the energy sectors. Will you commit to coordinating the analysis with CFTC and encouraging Congress, engaging us throughout the process? And are you willing to make the appropriate revisions?
We are very open to comment, including from members of Congress and from other agencies. We take those comments very seriously.
Mr. Chairman, I believe I've gone as far as I can go in the limited time, and I yield back.
I thank the gentleman. And without objection, I'd like to enter into the record a letter initiated by the gentleman from Wisconsin, Mr. Fitzgerald, to Chair Powell, Chairman Gruenberg, and Acting Director Sue regarding the Basel endgame. With that, I'd like to thank our panel, Vice Chair Barr, Chairman Gruenberg, Mr. Sue, Chairman Harper, for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair. The questions will be forwarded to them for response. I'd like to thank our witnesses and ask them to respond no later than December 15th. And I would encourage the room to take conversations outside as we turn this room for our 2 p.m. hearing. Hope everybody has a nice Thanksgiving, and thank you all for your testimony, for your engagement. And I thank all the members for accommodating this very long 10-week stretch Congress has been in session. Hopefully we'll come back in better stead. With that, House is adjourned. Well, not the House. The committee is adjourned.